everybody, it's time for our Mortgage Minute with Tatiana Ivleva-Lopez from Prosperity Home Mortgage. Hello.
Hey, Tatiana.
Hi guys, how you doing?
All right. Good hat, bad hat, naughty hat, nice hat. What you got?
No hat.
No hat.
No
It got,
hat with maybe a little bit of a small, nice hat.
Like
didn't
one
it
of
get
the
a,
little hat. I'm gonna say, you know what? I'm gonna get you some little hat props of various sizes, like from little tiny toy hats all the way up to like leprechaun and everything, and then a big sombrero.
yes, that'd be great.
That's what I'm gonna
I
get.
have
Didn't
sombrero.
we have an up and down this week? Like, wasn't it up for a little bit and then it came back down when the reports
Yeah,
came out?
yeah, they are improving slightly. I think it's
Okay.
in I guess just waiting for inauguration. I don't know. So they're improving a little bit right now. That's why I
Okay.
said maybe no hat or very small, nice hat.
Okay. I
So
do
let's
think, yeah.
let's take a look.
Okay.
We have new charts today for something new for you guys. It's 30-year average rate chart that goes back all the way to 1972 and right now 2025 with the breakdown of rates right here. So average rate is around 7.04. Last week it was actually 7.11, if you remember.
Yeah.
So there is some improvement, but in general, they did stay flat, with slight improvement right now in the past 1-2 days. Several factors have driven rates up this winter. Strong economic data, lowering expectations for the Fed to cut the rates again, and it caused 10-year Treasury yield. That's the key benchmark for the home loan rates. That's what we look at, 10-year Treasury yield. So that went up. And they're concerned that Donald Trump's the incoming administration will stroke inflation and boost government debt deficit. That all rattled the mortgage market. So we'll see what happens.
Yeah.
Now, I was looking at predictions. If probably in the beginning of last quarter, everyone was optimistic, saying that rates are going to be in fives. Then it started climbing up to in six. Now it's in the high six. So we'll see what happens.
Yeah.
I thought that was a load of hooey when they were saying that. Like I didn't buy it for a second because I keep saying I think the feds have been like for the past year and a half have been dangling this we're gonna lower interest rates in front of everybody and it's not doing anybody any favors.
Yeah.
That's true. Yeah.
Except for the fact we have no inventory. So
That's true. Yeah.
I say a lot of true things.
Nothing's doing anybody any favors right now. And there are some ways that people can get their rates down, like buying points and different things like that. But one of the best ways to get your rates down is your credit score and making sure you have that optimal credit score. So you just did a class recently on credit scores. So can you give us like a quick rundown of what buyers can do to really optimize their credit score when they're getting ready to buy a house?
Yes, so it's true. The credit score is one of the main factors that increases or lowers your interest rate, right? So that's why this average rate, that's for taking in consideration higher credit score, and some people have lower score, and that's gonna negatively affect the rate. So
Gotcha.
here, just in general, what we have a little chart. Or whatever you call it, with what rates could be. So they could range from 300. I've never seen in my 22 years career. I think the lowest I saw is 420 and up to 850. And, also hard to get there. It's hard to get that low and it's hard to get that high up. But honestly, once you're at 780 plus, score bracket, you're gonna get the best interest rate. If there is a mortgage insurance, you're gonna get the lowest premium on that as well. So 780 and above is a sweet spot. 740 to 780 is actually a very good rate scores, and most people, actually a lot of people fall into that category. So that is your target. That's where you want to be. So what actually affects the credit score? 35% effect is your payment history. Obviously, we want to see how you making your payments, how you handling your debt, paying it on time. You have collections, bankruptcies. Those will definitely have a negative effect on your score. So even if you were late on your credit card that has $2 balance on it, that is gonna have a huge 35% impact on your credit score. Another one is very important is the amount you owe on your credit cards. We call it debt utilization ratio. So basically, we look at the percentage of what your balance is comparing to your limit. Are you maxing out on your credit card or not? So the best is to be at 6 to 10% of the limit.
Oh, wow.
And somebody will say that, well, I use my credit card for points maybe, right? And then I pay it off at the end of the month. So I carry zero balance. So a little trick, if you wait until the day when the payment is due, the credit card company will actually report the balance that you had. But so there is a billing cycle that ends before the payment is due. So you need to know when the credit card reports to the bureau. And you can call them and say, when do you report to the bureau? And make sure that you pay before they report, not at your due date, but before they report. And then they will report zero balance. And obviously that's gonna help to increase your credit score. And when I look at clients' credits and I see that there is potential for them to increase the score because of that debt utilization ratio, and I just recommend them just pay it off or pay it down. Sometimes actually paying it down better than paying it off. And I can run that simulator for them and tell them what they need to do. And it actually improved the score drastically. It's easy to do, unless of course you're not able to pay down to 6 to 10%, because maybe you don't have that much money.
Right.
Another option would be for client to ask to increase their limit. So this way that percentage of balance versus limit is gonna naturally go down.
I have a question for you. Okay, so I have a credit card that I haven't had a balance on in I don't know how long. And when I was going through, just to check, because I'm like, does this one have an annual fee? But every month I kind of go through and I check everything. And I saw that they lowered my credit limit from like 21.8 to 15.4. So I called them and they said they lowered the limit due to inactivity. Would that show up? Now, I was able to, luckily I caught them in time and I'm like, no, I want you to please take it back up. And I thought I'll get gas on it this month. But would that show negatively on a credit report that they lowered my limit?
Not really, because again, they score you based on your amount owned versus the limit. They don't really score you if your limit is low. They don't really score you.
But maybe my overall.
Yeah. So do they do it like if you have 5 credit cards and your total credit limit's 100,000, and across those 5 credit cards you've used 25,000? Do they say, okay, it's a 25% utilization, or do they do the utilization for each credit card and then average that number? Because if it's the broad number, the rate goes down.
Exactly. So they looked at each credit trading.
Got it. Okay.
That's why, sometimes they have clients with 5 credit cards with small balances on them, and they, in preparation of getting, ready to buy, they think they need to clean everything up. They open new card, they move all the balances into one and close out those 5, which they had 5 years history on. So they actually
Yeah.
shoot themselves 3 times
Yeah.
because they had 5 cards, which is good to have more than one, because it's harder to keep up with 5 than 1. So you get scored on if you have more trade lines and you are organized enough to pay on time. And
Okay.
so that's one negative. Then the credit history gets wiped out, right? And the third
Yeah.
one is the debt utilization goes up. So they do look at each trade line separately.
Okay.
Gotcha.
Okay.
Okay, that's why you always talk to your lender before you do
Yes.
anything when you're looking for a mortgage.
Because it doesn't all make obvious
Yeah,
sense.
it's not logical.
Yeah.
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 Okay.
Yeah. Don't
Thank you.
diagnose and don't self-medicate yourself.
That's right.
Right.
That's right.
No Google MD.
Yeah. All right. So another one, the credit history, just like I mentioned in that little story or example, right? So you have longer your credit history, the better, of course. If you have a newer credit history and you're doing everything right, but your score is lower, just give it time because it's new. So you need to have some time for that start going. And then we have 10% effect on new credit. Actually, it would be a negative effect because in the beginning, when you open something new, it's an inquiry and it's some new debt until they see that you using it and you using it right conservatively, then it actually in the long run, it's a plus. It's a good effect on your score.
Okay.
Gotcha.
10% also type of credit in use. They like to see variety. They like to see maybe revolving accounts like credit cards, installments like car loans, student loans, mortgages. So they like to see the healthy mix, so to say, right?
Okay.
So, and just to reiterate, the ways to improve the score: pay your bills on time, get current if you have past due amount, and stay current. Reduce balances on revolving credit cards to 6 to 10%. And the balances are determined by a statement, so you want to make sure you paying it before the statement comes out, before the due date, and you can check with your credit card when they report. Don't open new credit cards that are not needed, especially when we're talking about, like in preparation of getting a mortgage, right? So you don't want to open a card without talking to the consultant first. Increase your limit.
How long is it considered new, Tatiana? Is it like 3 months, 6 months, 12?
Typically it's 6 months.
Okay.
Yeah, so but in general, like even sometimes it's even 1 year. If you don't really need it and but you have it, and then it's kind of hurts your debt to income ratio. Yeah. So
Okay.
increase your credit limit when it makes sense, just like I mentioned, right? Like if you cannot pay down, increase the limit, but don't increase the balance.
Yeah. Yeah.
Right? Keep the balance down. Don't close the unused cards. Again, back to my story, right? Keep it
Yep.
open. Put it in the freezer if you're afraid you're gonna use it, but just keep it open. Dispute inaccuracy. I recommend a lot of people now check their check their credit scores and kind of follow what's going on in their accounts. Everyone is entitled to one free credit report from each bureau. So I recommend to get reports from each bureau: Equifax, TransUnion, Experian. Why? from all of them, not just one, because not all creditors report to all 3 credit bureaus. And if you just check in Equifax, for example, you might not know what's going on in TransUnion and Experian, because the creditor might not report to those, and maybe there are some fraudulent activities and you don't even know that somebody opened a card under your name because they're not reporting to the bureau that you actually following. So to get the full picture, use check the reports on all 3 bureaus, which you're entitled to.
Okay.
Gotcha.
And of course, use the credit, because cash isn't always king. And
That's
I
right.
know there are people that don't like using credit cards. And I get it. The thing is that this is the way, when you want to get a mortgage, when you want to get a loan, this is the only way for bank to analyze and see if you're credit worthy, right? And this is the only way to do it. So use it very conservatively. Don't overspend, and just use it a little bit, but don't go fill up your car and 5 minutes later pay it off. That's not gonna do any good. Just wait for a billing cycle and then make it.
Okay.
Yeah. So
Okay.
that's
Awesome.
about it.
Okay, one quick question. The 6 to 10% on the balances, if you're an overachiever and you go down to 3%, that could potentially affect your score negatively. Is that what I'm understanding?
I mean, not necessarily. I would say
Okay.
it's safe to pay it off or pay it down to 6 to 10%. It's more like when someone, like my client, let's say they have lower credit score, and what did I do? Hold on. Stop sharing. Let's say they have lower credit score, and I run simulator for them to tell them what they need to do to increase their score, right? And the simulator will tell me sometimes that they need to get it down to even $10.
Yeah.
Yeah.
And it's better than to 0. But that's
Okay.
only in case when we really need to improve the score fast and to a certain level. Then, they need to follow directions precisely. But in general, if it's really hard for you to know, do you need to be at 0 or $10 or
Yeah.
$11? So if you pay it to 0, you pay it to 0. It's still
Yeah.
gonna
Okay.
be better
Some
than
backdoor
keeping.
algorithm.
Yeah, it's different
Yeah.
algorithms. It's still
Okay.
better than keeping balances over 10%.
Okay.
Okay.
Good.
Awesome. Thank you. That's very helpful.
Yeah. Very good.
You're
Okay.
welcome.
If somebody needs to get in touch with you, how do they find you?
They can call me at 571-245-3000.
All
That's
right.
right. For the
All right.
best loan officer around.
That's right. All right. We'll see you next week.
Bye.
See you guys.